New York City, autumn 1929. In a corner office overlooking Wall Street, one man sits calm while the market burns. Traders scream, phones ring off the hook, fortunes vanish by the minute. But Jesse Livermore is quietly counting profits. He has just shorted the market at the perfect moment, earning over $100 million. Newspapers call him the Great Bear of Wall Street. Yet less than a decade later, he will be broke, disgraced, and dead by his own hand. How could one of the sharpest minds in market history build and lose multiple fortunes, each larger than the last? This is the story of Jesse Livermore, the man who rode Wall Street's wildest roller coaster. In this episode, we'll follow the rise and fall of Jesse Livermore, a trader who made and lost entire empires before most investors could blink. We'll see how a farm boy with $5 became a bucket shop legend, how he outtraded the titans of Wall Street during the panics of 1907 and 1929, how personal demons and shifting rules destroyed his fortune and peace of mind, and what timeless lessons about risk and discipline his life still offers today. Jesse Lauriston Livermore was born in 1877 in Shrewsbury, Massachusetts, the son of a poor farmer who believed speculation was sin. At 14, Jesse ran away from home with $5 in his pocket and took a job chalking stock prices at Payne Weber in Boston. Every day, he watched numbers flicker across the ticker tape, learning how prices breathed, hesitated, and reversed. He wasn't guessing. He was studying rhythm. Soon he began placing tiny bets at bucket shops, storefront gambling halls, where customers wagered on stock movements without owning any shares. Using notebooks of data and patterns he'd memorized, Livermore turned small stakes into consistent wins. Within a year, the clerks banned him. Too accurate, they said. At just 15, he earned the nickname the Boy Plunger. Newspapers wrote about the teenager who outplayed grown men in smoky betting rooms. By 20, he'd moved to New York City, where the real stock market awaited, faster, harsher, and infinitely more dangerous. What made Livermore unique wasn't luck. It was discipline. He recorded every trade, avoided tips, and treated the tape like a living creature whispering clues. But those bucket shops also trained his appetite for leverage and risk, habits that would one day magnify both his fortune and his downfall. His early success built the foundation of a trading philosophy still quoted a century later. The game taught me the game, and it didn't spare the rod while teaching. The boy from a farm was about to step onto the grandest stage in finance, Wall Street itself. When Jesse Livermore arrived in New York at the turn of the century, the market was a battlefield of ticker tape, rumors, and telegraph lines. He quickly learned that price, not opinion, was truth. In 1907, when the market began to tremble, he saw panic forming before most even noticed. Stocks were overextended, credit was tight, and whispers of bank failures spread. While others bought the dip, Livermore quietly went short. Then the panic hit. Prices collapsed, brokerage houses folded overnight, and Livermore, betting against the market, made an astonishing $3 million, nearly $100 million in today's money. Legend has it that J.P. Morgan himself summoned him to help stabilize the market, and Livermore complied, covering his shorts to ease the selling. Overnight, he became a national name, the speculator who profited from disaster but helped end it. 2 decades later, history repeated itself. By 1929, optimism had turned manic. The roaring 20s filled Wall Street with easy money, borrowed dreams, and radio-fueled speculation. Livermore sensed danger again. He built short positions quietly, ignoring the mockery of brokers who called him old-fashioned. When the crash came that October, his patience paid off. He reportedly earned $100 million, equivalent to over $1 billion today. But even in triumph, the seeds of ruin were sown. The same leverage that multiplied his profits would one day magnify his losses. Lavish mansions, yachts, and a lifestyle of public grandeur replaced the discipline of the bucket shops. Livermore had mastered the market cycles, but not his own impulses. The public saw Jesse Livermore as a genius, a man who could read the market's pulse better than anyone alive. But behind the headlines, his life was fraying. After his triumph in 1929, he struggled to hold on to his vast fortune. The US government introduced new regulations to curb speculation. Margin rules tightened and short selling was restricted. The game he had mastered no longer played by his rules. Livermore began losing heavily. By 1934, he filed for bankruptcy for the third time. Once worth the equivalent of a billionaire, he now owed creditors millions. Newspapers that once praised him as the Great Bear of Wall Street now mocked him as the man who lost $100 million. But his greatest losses weren't just financial. Livermore's personal life was marked by turbulence, failed marriages, estranged children, and the constant weight of public scrutiny. The thrill of trading that had once fueled him turned into exhaustion and self-doubt. "There is nothing like losing all you have in the world," he wrote later, "for teaching you what not to do." By the late 1930s, Livermore was still trying to stage a comeback. He even wrote How to Trade in Stocks, a book summarizing his trading system and mental discipline. Yet the markets had changed, and the world no longer wanted a man who thrived on chaos. On November 28, 1940, in the cloakroom of the Sherry Netherland Hotel in Manhattan, Jesse Livermore took his own life. In his pocket was a note to his wife. "My life has been a failure. I am tired of fighting." For the man who once ruled Wall Street, it was the final tragic plunge. Despite his tragic end, Jesse Livermore's ideas remained foundational for traders more than a century later. His methods, built from observation, discipline, and intuition, became the DNA of modern technical trading. He believed price action told the truth long before analysts and charts formalized the idea. Livermore's first rule: cut losses quickly. He said, "The difference between successful people and failures is that successful people learn to lose properly." To him, a small loss was tuition, a necessary cost of staying in the game. His second rule: let winners run. Livermore rarely sold too soon. He waited for the tape to tell him the move was truly over. That patience built his greatest fortunes. Third, the market is never wrong. If prices moved against him, he didn't argue. The tape wasn't lying. He was. This mindset separated professional speculators from emotional gamblers. But his greatest insight came not from trading mechanics, but psychology. Livermore recognized that markets move on human behavior: fear, greed, and hope. Every generation believes it has outsmarted these forces, and every generation proves him right again. His life also carries warnings. Livermore thrived in a loosely regulated world. Today's markets, shaped by algorithms, central banks, and transparency laws, demand different tactics. Yet his emphasis on discipline and emotional control is timeless. Books like Reminiscences of a Stock Operator, a thinly veiled biography of Livermore, continue to influence investors from hedge fund managers to day traders. They read not just for his victories, but for his honesty about failure. In the end, Jesse Livermore's true legacy isn't wealth. It's wisdom paid for in full. Jesse Livermore's story is both inspiration and warning. He rose from a poor farm boy to one of the richest traders in history, proving that intellect, courage, and discipline could outmatch Wall Street's biggest players. Yet his downfall showed that financial mastery means little without emotional balance. The same instincts that made him fearless in bull and bear markets also led him to overreach, to chase losses, and to measure worth in money alone. Livermore's legacy endures because he understood something fundamental. Markets are human mirrors. They reflect our hopes, our fears, and our inability to sit still when uncertainty strikes. His lessons, trade with patience, respect the market, control emotion, are as true for the digital age as they were in 1907. He built and lost fortunes, but the wisdom from his failures remains priceless. Every trader who studies his life is reminded that success in markets is temporary. Discipline and self-awareness are forever. Do you think Livermore's downfall was inevitable in an age before risk controls? Or could discipline alone have saved him from himself?